Something unprecedented is happening in the silver market right now, and I'm not talking about another routine price spike or temporary shortage. I'm talking about a structural shift so profound that it could rewrite the rules of precious metals investing as we know them. Right now, as I'm recording this, silver just shattered its all-time record high, surging past $66 per ounce. That's a 120% gain in a single year. But here's what should really get your attention. This isn't speculation driving prices. This isn't retail investors piling in. This is something far more powerful, far more permanent, and far more explosive for future price action. The silver market is experiencing its fifth consecutive year of supply deficits. Let me say that again because it's critical. 5 straight years where global demand has exceeded supply. And unlike previous cycles where demand eventually cooled off, this time the deficit is accelerating, the gap is widening, and the forces driving it aren't going away. We're witnessing the collision of 3 massive trends that have never converged like this before: the artificial intelligence revolution, the global transition to clean energy, and the largest monetary shift since the collapse of Bretton Woods. Each one of these trends alone would be enough to send silver prices soaring. Together, they're creating what could be the most explosive commodity setup in modern history. Let me walk you through exactly what's happening, why the traditional rules no longer apply, and what this means for anyone holding dollars, retirement accounts, or traditional investment portfolios. First, let's talk about the AI revolution and why it's fundamentally different from any previous technology boom. When we talk about artificial intelligence transforming the economy, most people think about software, algorithms, and digital innovation. But AI runs on something very physical: massive data centers consuming enormous amounts of electricity and requiring sophisticated hardware infrastructure. Every AI data center being built right now is a silver consumption machine. The servers, the cooling systems, the power distribution networks, the backup systems, all of them require silver. And we're not talking about small amounts. A single large-scale AI data center can consume thousands of ounces of silver in its electrical infrastructure alone. Here's where it gets interesting. Companies are racing to build these facilities at a pace we've never seen before. Tech giants are investing hundreds of billions of dollars in AI infrastructure. Microsoft, Google, Amazon, Meta, they're all in an arms race to build the most powerful AI computing capacity. And every single one of these facilities requires silver. The Silver Institute just released data showing that AI-driven data center construction is now a major driver of industrial silver demand. And this is just the beginning. We're in the first inning of the AI build-out. Analysts estimate that global data center capacity needs to triple over the next 5 years just to meet projected AI computing demand. Triple. That means 3 times the current silver consumption from this sector alone. But AI is only one piece of the puzzle. The second massive trend is the clean energy transition, and this is where silver demand becomes truly staggering. Solar panels are the single largest source of industrial silver demand, and solar installation is exploding globally. Each solar panel requires about 20 grams of silver. That might not sound like much until you realize that global solar capacity is projected to grow by over 300 gigawatts annually. That translates to roughly 150 million ounces of silver consumed by the solar industry every single year. And that number is accelerating. China alone is installing more solar capacity than the entire world was installing just 5 years ago. Europe is racing to reduce dependence on Russian energy. The United States just passed massive clean energy incentives. India is building one of the world's largest solar infrastructures. Every government on Earth has committed to net zero carbon targets, and solar is the cornerstone of those plans. Here's the critical point. Unlike other industrial uses where silver can potentially be substituted or recycled, solar panels lock that silver away for 25 to 30 years. Once a solar panel is installed on a rooftop or in a solar farm, that silver is effectively removed from the market for decades. It's not coming back into circulation, it's gone. Now add electric vehicles to the equation. The average electric vehicle uses about twice as much silver as a traditional internal combustion engine vehicle. Silver is in the battery management systems, the charging infrastructure, the power electronics, the electric motors. And EV adoption is accelerating faster than even the most optimistic projections predicted just a few years ago. The Silver Institute forecasts that automotive silver demand will grow at a compound annual rate of 3.4% through the end of the decade. But here's what makes that number conservative. It assumes a gradual transition to EVs. If we see accelerated adoption, which current trends suggest we will, that demand could be significantly higher. Think about what's happening in China right now. Over 40% of new car sales in China are electric vehicles. That's not a future projection. That's happening right now. Europe is banning the sale of new internal combustion engine vehicles within the next decade. California and several other U.S. states have similar mandates. The global auto industry is retooling entirely around electric vehicles. Every major automaker has announced plans to go fully electric or predominantly electric within the next 10 to 15 years. Ford, GM, Volkswagen, Toyota, companies that built their empires on gasoline engines are now betting their futures on electric powertrains. And every single one of those vehicles requires silver. So we have AI data centers consuming silver at unprecedented rates. We have solar installations locking away millions of ounces annually. We have electric vehicles doubling automotive silver demand. And all three of these trends are accelerating simultaneously. Now, here's where the story gets really interesting. The supply side of the equation. Silver mining is not keeping pace with demand. In fact, it's falling further behind every year. Unlike gold, which is primarily mined as a primary product, about 70% of silver comes as a byproduct of mining other metals, primarily copper, lead, and zinc. This means silver supply is largely dependent on the economics of mining those other metals, not on silver prices themselves. When copper prices are low, copper mines reduce production or shut down, and silver supply drops as a consequence. When lead and zinc operations become unprofitable, silver supply contracts. The silver market doesn't have the luxury of ramping up primary silver mining to meet demand because most silver isn't mined that way. And here's the kicker. Even when silver prices rise dramatically, it takes years to bring new mining capacity online. You can't just flip a switch and start producing more silver. Mining projects require exploration, permitting, financing, construction. The entire process typically takes 7 to 10 years from discovery to production. That means even if mining companies started aggressively developing new silver projects right now in response to these high prices, that supply wouldn't hit the market until the early 2030s. And by then, demand from AI, solar, and EVs will be exponentially higher than it is today. The World Silver Survey confirms that the market is now in its 5th consecutive year of structural supply deficits, not temporary shortages. Structural deficits. That means the fundamental supply-demand balance is broken and it's getting worse, not better. In the most recent year, the deficit was over 200 million ounces. That's 200 million ounces of demand that couldn't be met by current production. Where did that silver come from? Existing stockpiles, recycling, ETF liquidations. But those sources are finite and diminishing. Above-ground silver inventories have been declining for years. The silver that's easily accessible and available for industrial use is being drawn down. And remember, much of the silver being consumed today, particularly in solar panels, is being locked away for decades. It's not coming back into circulation. Now let's talk about what's happening in the financial markets, because this is where things get truly explosive. Central banks around the world are diversifying away from dollar-denominated assets. We're seeing the largest monetary shift since the 1970s. Countries are reducing their dollar reserves, increasing their gold holdings, and looking for alternative stores of value. And increasingly, that includes silver. The BRICS nations, Brazil, Russia, India, China, and South Africa, are actively working to reduce dollar dependence in international trade. They're settling transactions in local currencies, building alternative payment systems, and accumulating precious metals. This isn't speculation or conspiracy theory. These are official policy statements from major economies representing nearly half the world's population. When countries lose confidence in the dollar as a reliable store of value, they turn to hard assets. Gold has traditionally been the primary monetary metal, but silver is increasingly being recognized as a strategic asset as well. And unlike gold, silver has this massive industrial demand component that makes it even more valuable in a technology-driven economy. Think about the implications. If even a small percentage of global monetary reserves shift towards silver, the impact on prices would be astronomical. The entire above-ground silver market available for investment is relatively tiny compared to global financial assets. A modest reallocation could absorb years of production. We're also seeing unprecedented interest from institutional investors. Silver ETFs have seen significant inflows. Hedge funds are taking positions. Family offices are allocating to precious metals. These aren't retail investors buying a few coins. These are sophisticated institutions with billions of dollars recognizing that silver is fundamentally undervalued relative to its supply-demand dynamics. And here's something that should concern anyone holding traditional financial assets. The paper silver market is massively larger than the physical silver market. The COMEX and LBMA trade enormous volumes of silver contracts, but the actual physical silver backing those contracts is a fraction of the paper claims. This creates a situation where, if a significant number of contract holders demand physical delivery, the system could face a serious shortage. We've already seen stress in the physical market during something unprecedented is happening in the silver market right now. And I'm not talking about another routine price spike or temporary shortage. I'm talking about a structural shift so profound that it could rewrite the rules of precious metals, investing as we know them. Right now, as I'm recording this, silver just shattered its all-time record high, surging past $66 per ounce. That's a 120% gain in a single year. But here's what should really get your attention. This isn't speculation driving prices. This isn't retail investors piling in. This is something far more powerful, far more permanent, and far more explosive for future price action. The silver market is experiencing its fifth consecutive year of supply deficits. Let me say that again because it's critical. 5 straight years where global demand has exceeded supply. And unlike previous cycles where demand eventually cooled off, this time the deficit is accelerating, the gap is widening, and the forces driving it aren't going away. We're witnessing the collision of 3 massive trends that have never converged like this before. The artificial intelligence revolution, the global transition to clean energy, and the largest monetary shift since the collapse of Bretton Woods. Each one of these trends alone would be enough to send silver prices soaring. Together, they're creating what could be the most explosive commodity setup in modern history. Let me walk you through exactly what's happening, why the traditional rules no longer apply, and what this means for anyone holding dollars, retirement accounts, or traditional investment portfolios. First, let's talk about the AI revolution and why it's fundamentally different from any previous technology boom. When we talk about artificial intelligence transforming the economy, most people think about software, algorithms, and digital innovation. But AI runs on something very physical. Massive data centers consuming enormous amounts of electricity and requiring unprecedented amounts of silver. Every AI data center needs silver. It's in the servers, the cooling systems, the power distribution networks, the backup systems. And we're not talking about a few ounces here and there. A single large-scale AI data center can require thousands of ounces of silver just for the electrical infrastructure. And here's the thing. These facilities are being built at a pace that's shocking even industry insiders. Major tech companies are in an arms race to build AI capacity. They're not building 1 or 2 data centers. They're building dozens, hundreds, entire campuses of facilities. And every single one needs silver. The Silver Institute projects that AI-driven data center construction will increase silver demand by millions of ounces annually, and that's just the beginning. We're in the first inning of this build-out. But it gets more interesting. Unlike previous technology booms where demand could be met by ramping up production or finding substitutes, silver has unique properties that make it irreplaceable in high-performance applications. It's the most conductive metal on Earth for both electricity and heat. In AI applications where efficiency and reliability are paramount, there is no substitute. You can't use copper. You can't use aluminum. You need silver. Now layer on top of that the clean energy transition. Solar panels require silver. Each panel uses about 20 grams of silver in the photovoltaic cells. That might not sound like much until you realize that global solar installations are exploding. We're not talking about incremental growth. We're talking about exponential expansion driven by government mandates, corporate sustainability commitments, and the simple economics of renewable energy becoming cheaper than fossil fuels. The solar industry alone consumed over 140 million ounces of silver last year, and that number is projected to grow by double digits annually for the foreseeable future. Countries around the world have committed to massive solar build-outs. China is installing solar capacity at a rate that would have seemed impossible just 5 years ago. Europe is accelerating its renewable transition. The United States is pouring hundreds of billions into clean energy infrastructure. And it's not just solar. Electric vehicles are another massive source of silver demand. Every EV requires significantly more silver than a traditional internal combustion vehicle. We're talking about 25 to 50 grams per vehicle for the electrical systems, battery management, and charging infrastructure. And EV adoption is accelerating faster than almost anyone predicted. The Silver Institute forecasts that automotive silver demand will grow at a compound annual rate of 3.4% through the end of the decade. But here's what makes that projection conservative. It assumes a relatively gradual transition to electric vehicles. If adoption accelerates, If governments implement more aggressive mandates, if battery technology improves faster than expected, that demand could explode even higher. Think about what's happening in the automotive sector right now. Major manufacturers are committing to all-electric lineups. Countries are setting deadlines for phasing out internal combustion engines. The infrastructure for charging is being built out globally. This isn't a maybe. This is happening, and every single vehicle in this transition requires silver. Now here's where it gets really interesting. All of this industrial demand is hitting a market that's already in deficit. Silver mine production has been essentially flat for years. There are no major new silver deposits being developed. The easy silver has already been found and mined. And unlike gold, where mining is the primary source of supply, about 70% of silver comes as a byproduct of mining other metals like copper, lead, and zinc. That means silver supply is largely dependent on the economics of other metals. If copper prices are weak, copper mines slow down, and silver supply drops as a consequence. Silver miners can't just ramp up production in response to higher silver prices, because most silver isn't mined primarily for silver. It's a structural constraint that's incredibly difficult to overcome, and the deficit is real. The World Silver Survey confirms that the market has been in structural deficit for 5 consecutive years. That means every year, global demand exceeds newly mined supply plus recycling. The gap is being filled by above-ground inventories, by existing stockpiles, by whatever silver can be scraped together from various sources. But here's the critical question. How long can that continue? Inventories aren't infinite. The silver that's been accumulated over decades is being drawn down. And unlike gold, which is primarily held as an investment and rarely consumed, silver is an industrial metal. Once it's used in a solar panel or an electronic device, it's effectively gone. It's not economically viable to recover it. The silver is consumed, dispersed, lost to the market forever. This is creating a situation that's unprecedented in modern commodity markets. We have accelerating demand from multiple sectors, constrained supply that can't respond quickly, and depleting inventories. It's the perfect setup for a price explosion. And the market is starting to wake up to this reality. Look at what's happened to silver prices recently. The move from $30 to $66 wasn't driven by speculation or retail frenzy. It was driven by industrial buyers securing supply, by institutional investors recognizing the structural deficit, by smart money positioning ahead of what they see coming. And here's something that should really get your attention. Central banks are paying attention to silver in a way they haven't in decades. While everyone focuses on central bank gold buying, which has been at record levels, there's a quiet recognition among monetary authorities that silver's role as both an industrial metal and a monetary metal makes it uniquely valuable in the current environment. Think about what central banks are dealing with right now. They're managing currencies in an era of unprecedented monetary expansion, geopolitical fragmentation, and technological disruption. They're looking for assets that have intrinsic value, that can't be printed or digitally created, that have real-world utility. Silver checks all those boxes. The BRICS nations, in particular, are exploring ways to incorporate commodities into their trade settlement systems. They're looking at gold, yes, but also at silver and other strategic materials. They're recognizing that, in a world where the dollar's dominance is being questioned, where sanctions can freeze currency reserves, having real assets with industrial utility provides both economic and strategic value. Now, let me pause here for a moment, because if you're sitting on $100,000 or more in retirement accounts, this is directly relevant to your financial security. I've put together a comprehensive guide on how gold IRAs work, how you can get physical precious metals into your retirement account without triggering tax penalties, and why this might be worth considering given what's happening in the silver and gold markets. You'll find that in the description below. It's free, it's detailed, and it covers the mechanics that most financial advisors won't tell you about. Worth checking out if this applies to your situation. All right, back to what's happening in the silver market and why this setup is so explosive. Let's talk about the paper silver market versus physical silver, because this is where things get really interesting. The vast majority of silver trading happens in paper markets, futures contracts on the COMEX, exchange-traded funds, derivatives. These paper claims on silver dwarf the actual physical silver available for delivery. The COMEX silver market, for example, trades hundreds of millions of ounces daily. But the actual silver available for delivery in COMEX warehouses is a fraction of the open interest in futures contracts. Most of these contracts are settled in cash, not physical delivery. The system works as long as everyone plays along, as long as most participants are happy to trade paper claims rather than demanding physical metal. But what happens when industrial users, who actually need physical silver for manufacturing, start competing with investors who want to take delivery. What happens when the paper market's leverage gets tested by real physical demand? We've seen glimpses of this tension already. There have been periods where premiums for physical silver coins and bars have spiked well above the spot price. There have been delivery delays, supply constraints at mints and refineries, situations where you couldn't buy physical silver at any reasonable price even though the paper price suggested silver was readily available. This disconnect between paper and physical markets is a powder keg, and the more the industrial demand grows, the more that physical silver gets consumed in irreversible applications, the more unstable this system becomes. At some point, the paper market's price discovery mechanism breaks down. At some point, physical scarcity overwhelms paper trading, and when that happens, the price adjustment could be violent. Think about what happened in other commodity markets when physical scarcity met paper market leverage. Think about the nickel market crisis where prices went parabolic because actual physical supply couldn't meet delivery obligations. Think about the uranium market where years of underinvestment in mining created a supply crunch that sent prices soaring. Silver has all the ingredients for a similar dynamic, but on a much larger scale because of the multiple demand drivers converging simultaneously. Now let's talk about the historical context because silver has done this before. In 1980, silver hit $50 per ounce, which adjusted for inflation would be over $180 in today's dollars. That spike was driven by the Hunt brothers trying to corner the market, by inflation fears, by geopolitical instability, but the fundamental supply-demand dynamics weren't nearly as tight as they are today. There wasn't the structural industrial demand we're seeing now. There wasn't the clean energy transition. There wasn't the AI revolution. In 2011, silver hit $49 per ounce during the aftermath of the financial crisis. That was driven by monetary concerns, by investors fleeing to hard assets, by fears about the dollar and sovereign debt. But again, the industrial demand picture wasn't what it is today. The supply deficit wasn't 5 years deep. The inventory drawdown wasn't as severe. What we're seeing now is different. This isn't a speculative bubble. This isn't a temporary squeeze. This is a fundamental restructuring of the silver market driven by irreversible technological and economic trends. The AI revolution isn't going away. The clean energy transition isn't going away. The supply constraints aren't going away. And the deficit is getting worse, not better. Some analysts are projecting silver could reach $100 per ounce within the next few years. And honestly, when you look at the supply-demand fundamentals, when you consider the historical precedents, when you factor in the monetary dynamics, that might be conservative. If the paper market breaks, if physical scarcity becomes acute, if industrial users start panic buying to secure supply, we could see prices that make $100 look quaint. But here's what's really important to understand. This isn't just about the price of silver. This is about what silver represents in the broader economic transformation we're living through. Silver is at the intersection of the digital revolution, the energy transition, and the monetary reset. It's a physical asset with irreplaceable industrial utility in the technologies that are reshaping our world. Think about the implications. If silver becomes genuinely scarce, if prices rise dramatically, what happens to the cost of solar panels? What happens to the cost of electric vehicles? What happens to the build-out of AI infrastructure? These are the technologies that governments and corporations have committed trillions of dollars to deploying. They can't just stop because silver gets expensive. They'll pay whatever it takes to secure supply. That creates a feedback loop. Higher silver prices don't destroy demand the way they might in a purely discretionary market. Industrial users need silver. They'll pay up. That supports higher prices, which draws down inventories faster, which creates more scarcity, which drives prices higher still. And then there's the investment demand side. As silver prices rise, as the story becomes more widely understood, as investors recognize the structural deficit and the supply constraints, investment demand accelerates. People who've never thought about silver start paying attention. Institutional investors who've ignored the silver market start allocating capital. Retail investors who missed the early move pile in. We've seen this pattern before in commodity supercycles. The fundamentals improve gradually, then suddenly everyone notices at once, and prices go parabolic. Silver has all the characteristics of being in the early stages of that kind of move. The fundamentals have been improving for years, the deficit has been building, the inventory drawdown has been happening quietly, but now the price is starting to reflect the reality, and once that process starts, once the market reprices to reflect genuine scarcity, the moves can be explosive. Let me give you some specific numbers to put this in perspective. Global silver demand last year was approximately 1.2 billion ounces. Mine production was about 830 million ounces. Recycling added another 180 million ounces. That leaves a deficit of roughly 190 million ounces that had to come from existing inventories. Now, 190 million ounces might sound like a lot, but in the context of global industrial consumption, it's not. That's less than 2 months of global demand. And remember, this is the 5th consecutive year of deficits. The cumulative drawdown of inventories over 5 years is approaching 1 billion ounces. That's 1 billion ounces of silver that's been pulled from stockpiles and consumed in industrial applications where it's not coming back.